is the Ides of September, September 15, 2022. Okay, so let's get this, let's kick the show off here. Let me share my screen. No. I'm like a monkey studying a math problem when I'm doing that. Okay, here we go. So for anybody new, first of all, welcome. The ground rules here are mute yourself while we're going through comments, but feel just that's rule number one. You know, there's background noise. Rule number two, ask a lot of questions via chat or just interrupt me. The point here is to help you use the platform. So if you're new and you're joining for the first time, thank you for doing it. Hang on, one more person here. Oh, did we lose Greg? We did. Okay. All right. So here's the desktop, and or dashboard. This is the app. I've got basically five things that I want to go through, but I'll go back to sort of the basics here. I think about what's the broad market doing, broad market sentiment. What's the context? Are there things happening in the market that we should be aware of? You know, you watch CNBC all day, and you would think that every day is going back to square one, and it's just a relentless the infinite game. Well, it is that in a sense, but there is a cadence and a clock and a calendar for the market, and it's good to understand what that is. So one of those core things, context, is options expirations. Sorry. Okay. If you just joined, you haven't missed anything. We're just getting going. So broad sentiment, we'll talk about that in a moment. That's point number one here. But context, options are expiring today, Thursday, Friday. If you want to see the calendar, go here to the landing page for Market Structure Edge, and under Resources, you will see the expirations calendar right there. So this is sort of unusual, where for a quad means that options and futures on stocks and indexes, that's how you get to 4, quad, are expiring. And so this is September, and today is the beginning of expirations. Usually they run right in a row. 3 days in a row, there are expirations. VIX, volatility instruments, it's a very big asset class. You can think of it this way. You can buy stuff, you can sell stuff, you can trade the gap. The gap, that's it. That's volatility. And so when there are 3 in a row like that, you know, they're long short options or derivatives that are expiring, and VIX. The VIX this time is the 21st. So it's next week. It will coincide with Jay Powell's whatever he's going to do. 75 basis points, 100 basis points, I don't know. It will be big, and who knows, you know, what will happen then. But this split tends to mean that there is more volatility. There's an opportunity to trade the new options on the 19th versus volatility. There are other things that go on, but that's the context. So we know those things are occurring. And why does that matter? Well, because it can alter outcomes. Derivatives are like black holes. You can't see them, but you can get sucked into them, right? So I'm often very careful around those. You know, if broad sentiment has been very strong into options expirations, I really try to be out of everything. When broad sentiment is rising into them, I'm less concerned about being out, because there's a higher probability of a carry through. Doesn't mean it'll always work. But I always think about the context and my exposure, and the fact that the math may not work the way that it does normally because of those distorting effects. Questions about that? Okay. So then we go for the BCD. Divergence is the.
Oh, I'm sorry, Tim.
Yeah, go ahead, Barry.
Sorry.
Yes.
You're saying if broad sentiment is rising, you'd be less concerned? Is that what you're saying?
Yes, correct. So
like it is now, you mean?
Right. So
okay.
I have 2 positions right now.
Okay.
This is killing the markets, that high level of supply. But yes, generally, if we're here at options expirations in August, with broad sentiment having peaked and spent all this time above the red line, I don't want exposure, because I don't know what's going to happen, right? So the market popped up and then collapsed. Well, you know that once again, the statistics prove true. The probability of additional gains in the stock market once the demand side sentiment rises above 6.4 is negative. And it was true again, it was just delayed. You know, if you look at where the SPY was when the markets topped, it was at 411. So where is it now? Well, yesterday it was at 394, 395. So absolutely proved true. Sure, there are things we could trade in there, and I did. And you know, this has been a very good trading stretch for me. Right now, MO is crippling my returns, but I had good returns and other things all kind of evened out. But it's been a very good period to trade. So, but that's
You'll collect the dividend.
Say again.
You'll collect the dividend.
I will. Yeah, it's not an aim, but yeah, there's that. Yeah,
that helps.
Not really what I'm after, but it's okay, right? So let's come back to broad sentiment. So I wanted to talk about this. I want to look at the 3-year view and show you something, because you know you'd say, well, how come the market is struggling if sentiment has bottomed and is rising? Shouldn't the stock market be rising? Well, there are two things that are context again. Derivatives during periods of instability devalue. They get mark to market, zero. That's a lot of market cap. It's statistically about 18%. I always say round figures. It's about 20% of market cap rests on a right but not an obligation to do something in the future. That's what a derivative could be. Long, could be short. So when prices are unstable, so are those, and so you see that effect in here. And then the supply side. So for those who are brand new to Edge, supply is short volume. Demand is an algorithm that takes into account the different purposes and time horizons that drive buying and selling. You know, for instance, my horizon tends to be 2, 3, 4 days, something like that. Could be longer, but that's kind of my aim. So that's my investment horizon in effect. High frequency traders have an investment horizon of a day or less. Generally, you know, 100 milliseconds. That's Citadel, Virtu, Hudson River Trading, Jane Street, Susquehanna, folks like that. Did you see that Holman Jenkins in the Wall Street Journal wrote about Jeff Yass? I wrote about Jeff Yass August 24th. How, you know, he's the guy, one of the co-founders of Susquehanna, very, very successful fellow who trades short term and then invests in private equity long term. There's a lesson. Trade the market, invest in private businesses. I think that's really kind of the key, but it's a whole different discussion. So then you have, you know, long-term stock pickers who will have horizons of 3, 5, 10 years, you know, that sort of thing.
Yes.
And then you have, hey guys, mute yourself if you could, please. Thank you. And then derivatives as an end unto themselves. And a lot of you trade puts and calls, right? So those are purposes and time horizons that drive how the market behaves. So you can't always think about fundamentals as the driving purpose. So, okay, so here's what I wanted to show you. If you look at the supply side, short volume, not short interest, but the percentage of trading volume, in this case, in the stocks comprising the S&P 500, that is from borrowed stock, it's very high. It's consistently, the lowest point in the 3-year period was right here, right at the bottom of the pandemic pullback. So you could look at sentiment way down here and supply way down here. What's the probability that the market rises? Well, virtually 100%. And that's fairly consistently true. You could look at, you know, the demand side here below the green line. Let me zoom that in a little bit. Demand side below the green line, supply side falling. What's the market likely to do? Rise. It can change very quickly. That's right at options expirations, but that's a very consistent rule of thumb. And you could look here. This is where there was a lot of meme stock creation. But from this period, from about, let's call it September, there was a pullback in the FANG stocks then. From September all the way to December, September of 20 to December 2021, look at how low the supply was in the market. And what did the market do? It rose. Since then, it's been very challenged. This is what fuel, this decline in supply was a principal driver of the gains here. So where are we now? Well, the demand side is recovering, but we haven't even gotten back to the green line, let alone the red line. And supply is at record levels. We were very, very, very close to it here, but we're actually higher here at a little over 50% than it's ever been. And so when there's a lot of supply and demand hasn't even gotten back to 5, the market could really struggle. And it's borne out in the data too. So that's why broad sentiment is so important. It will reduce the opportunities to trade things. And that manifests in the fact that the math doesn't give us much. Big and stable, which are stocks that tend to do well in volatile markets, well, they're up to 6. 3 days ago, there were none in it. So we have a handful there, but if you looked at the average for these 6, look at the supply side. The supply side is not very good. The demand side has gotten back to 5. That's good. But if supply is increasing at a generally faster rate than demand, it's very challenging. And if I look at these big and stable stocks, and that's just math. The math is going to go look for the criteria that we assign to this portfolio. So the criteria are up here. And of course, this one we create, so you can't edit it. But so Black Knight is the newest entry here. So if we look at this data, here's the trouble. You can see it right away. There was a very nice decline in the supply side here that fueled a very nice increase in price as demand stayed very level. But now look at it, right into options expiration. The supply side's rising, demand side's level, but then price stops rising. So let me get rid of that. And if you went through each of these, you would find it to be consistently true that the data are not great. The supply side is the issue, not the demand side. Look at Novartis. So big decline in the supply side here. You would expect a very nice run, but it fell apart the last 3 days as the supply side rose. So then it's a very important lesson about entries and exits. So was this great? No, the math only gave it to us a couple of days ago because of the fact that it's returned to maybe even just yesterday. I'm not sure. I'd have to go back and look. But the principle here is stocks that spend a lot of time at 5 tend to be more stable than stocks that bounce to 10 and back to 1 and 10 to 1, right? So that's volatility. But it's very important to know to use supply-demand divergences as your entry point. And when any side of that changes, there's your exit. And if you're disciplined about that, most of the time it will work out. I wanted to also point out some stuff that I noted on Benzinga Monday. So, let me go back here because I want to show you the averages. So once again, and you see this all over the market. I highlighted stuff with sort of stable demand and falling supply. That was on Monday. That's already changing. There are 4 stocks in here that I highlighted. I said, you could EverSource, utilities. I mean, you could say, well, it's logical, Quast, that money would go to utilities. Yeah, but all utilities are not equal. Things that spend a lot of time at 5 or better tend to outperform the market. And EverSource certainly has done better than the broad market here of late, and the supply side has fallen. But even here, it's not dropping anymore. That's still pretty good. I mean, I look at that and say, well, if I'm going to own something, ES is a pretty good bet. Steady demand, deficiency in supply, but it is starting to rise. I think I heard somebody knocking. Let's let Pablo in. Okay, there we go. So Philip Morris, another one that I highlighted. Again, it's pretty good. You could say, well, demand is steady, supply is below the trend. That should do pretty well. But again, it's ticking up a little bit. There's the Steve Hicks principle. The 1 day up, down. By the way, we have that working. We just have like 6 different things that have to go into a release. Internally, it's slated for tomorrow. We'll have to test to see how it goes, but it would give us the ability to look for a 1 day, 5 day, 30 day trend in short volume. So, excellent. Yep, we will get there.
Tim,
So
quick
that should be
question.
helpful. Yes, please do. Fire away.
So even though demand was flat and then supply was dropping, you see that as an entry, even though demand was flat?
It's not a great entry. You're right. It's not perfect. I'm just saying it's better. It's it's better than nothing.
Got it.
I say
Yeah, yeah.
you could choose, right? When I look at that and say, well, am I buying that? No, I mean, I'm not, because options are expiring. Will I buy something today? No. Will I buy something tomorrow? No. Will I buy something Monday? No. Monday, when new options trade can be very challenging. Doesn't mean you can't, but I just prefer not to do that because
Yeah.
there's greater risk, right? But if I
Yeah.
looked at that, I would say probably proportionately there is more institutional money going into Philip Morris than other stocks on a weighted basis. And look at this, passive investment is the lead behavior. It's very liquid, $10,000 at a time. I mentioned this in the market desk note. The liquidity has the top 1,000 is down to almost $3,000 so that what I mean by that is that if you take the top 1,000 most liquid stocks as measured by the amount of money you can trade at a time, the lowest rung is around $3,000. Used to be $4,000. So for institutions, that's very, very challenging, right? If I have $100 million, how do I get it out of Philip Morris $10,000 at a time with algorithms? That's why 97% of orders are executed by algorithms. I can't just go I have a 100,000 share order to trade. Well, it's going to take, I was on a call yesterday with guys from State Street and Luminex. So, State Street is running institutional money. Luminex is an agency broker doing the same thing, executing trades. Well, that's their biggest struggle is, how do I get in and out of something? So it's a very important consideration. So when I'm buying Philip Morris, I don't buy more than that at a time, because then I stand out. And a machine is going to look and go, ooh, there's an idiot. So let's run the price away. They'll run the price up and I buy too, and then immediately the price goes down. Well, I try to diminish that likelihood, but with small trades and maybe 99 shares so that it's less than 100 shares. I've explained this before, but if you're new, a trade for 100 or less shares at the market, meaning, so Philip Morris has usually maybe 2-3% spread. Well, why put in a limit order? Are 2 or 3 cents going to be material for us? Nah. So I would just buy it at the market, 99 shares, and I know my trade's going to instantly fill at the best price. So why wouldn't I use that? And that's exactly what algorithms do. Very few algorithms are using limit orders. They're small market orders, and they like liquid stocks where there is a very small spread. It's much harder to get in and out of, let's take STE, for instance, a stock that I currently own, and I'll show you why. But it's harder to trade, right?
So when you do 99 shares or less, it has to be the best price?
I will. I will, because I know it's going to get executed. But because there's a big spread, I'm more likely to do a marketable limit order. That is, let's suppose you know what that means. Here, by the way, here's demand, here's supply. So those things are moving opposite directions, divergence. So even though the price is down, I would look at that and say, well, I'd be happy to own that stock. That's why I do. I might buy more of it. I'm not now, but it's the kind of thing where if the price dropped, I'd buy more of it, because I believe that the supply demand equation is in my favor. But so the spread in this stock, see, it's 203.65. Well, the spread will be 25 cents. Well, that's kind of material. If you own 10,000 shares, it might not be. But if you own 400 shares, that's pretty material. So if the offer to sell is 203.65 and the bid to buy is 203.40, I'm going to put in a bid around 203.51, right, for 50 shares. Will some high frequency trader come in there and go, I'll midpoint that? Yeah, probably, because they can buy it for a slightly smaller price and sell it to me for a slightly higher price. That's what they're going to do. So you want to know those things as a trader. That will make you a more sophisticated participant in the market, able to get a better price.
Hey,
okay,
Tim, let me ask you a question about the math.
Yeah.
So the math says that, tomorrow, Monday, Tuesday, Wednesday, at some point in the next 5 days or so, the market's going to be challenged because just the math has to take effect because supply is so high.
Right.
How could the math get delayed? And I guess it could, because obviously everybody's positioning for what the Fed may or may not do, irrespective of what happens with expiration. So happens we get VIX on Wednesday, we get the Fed on Wednesday. What's your thoughts on that?
Yes, things can be delayed. Unfortunately, market structure is not a metronome. It doesn't carry an absolute beat. I always say central tendencies. So, if demand begins to rise, could price be ahead of that? Well, sure it could, or behind it. And so it happened this time. Prices in the broad market rose while sentiment was still falling. It was below 4.0. So I could say 5 days from now, the market's likely to be higher. Sure enough, it was, but now it's reverted. What causes that? I absolutely think, Barry, that there are distorting derivatives bets. I could share something. It's not on edge. We can look at all kinds of data, but I can tell you, looking at the data, that what happened September 13th when the Dow dropped 1,300 points, that before that, I could see it in SPY. That SPY's short volume went from 48% to 67%. So that told me that big institutions who had, let's say they used a basket of stocks. Here, BlackRock is a basket, or State Street in that case. Here, State Street is a basket of stocks. Give me a bunch of SPY. SPY rises. Then they go, we want to be out of this before the CPI data come out. So then the market makers know. So they start to short SPY. And a couple of you sent me notes and said, I bought puts on SPY too. Well, that was a good call. I mean, it was a bold call because I'm not sure I would have done that. But that is what caused them. So then all the market makers know, and they dump the basket of stocks and they short SPY and they short the derivatives. So can we see all of that? Yeah, it's hard. The biggest tell is exactly what I talked about the whole time. This was the trouble. Those things should move opposite, right? The price hit its peak when short volume hit its nadir. And you can see that over and over and over in the data, with the occasional exception of options expirations. So the fact that the market bought, this tells us everybody short the market. That's what it tells us, right? So we do have that warning. Yeah.
Definitely keep your daily warnings going, because it was interesting with on the supply side when it had that. It was just a little bit of a dip. It was still over 50, but it was a little bit of a dip. And I would say, if it wasn't for your email clarifying that, hey, you're still over 50, don't go. It's not advisable. One could have misinterpreted that little dip as, hey, it's about to be all cleared. It wasn't.
I agree.
Thank you.
Well, I'm glad it helped. I mean, I couldn't predict. I would not have been able to tell you, oh, the market's going to fall 1,000 points. But I was very concerned about that. That if there's no change in the supply side, it's like stomping on the throttle of your car with your foot on the brake. It's really hard to get any momentum with all that supply in the market. So I'm glad that it was helpful. It makes me very cautious, right? So if, as soon as I just made a great amount of money in Meta. It's $10 a share. I mean, it was much better than my target. I like 2, 3, 4%, but I sold it, right? I shortened my time frames because of that. I'm not going to hang around if I can avoid it. And I can't always, I don't sit and watch stuff. I just look once a day at where things are, and then I know, okay, well, probably tomorrow I should sell that or whatever. But this has made me shorten my time frames. Great lesson. When this is occurring, you don't have to, right? You know that the supply side is really helping prices. The moment it started to move up, the market was already starting to move. Notice options were expiring right there. That's a turning point. We know. These conditions were going to change. Yeah. Let's see.
I think August 17th was one of the best signals that I've seen market structure give. I mean, it ticked up, and it was just like the perfect signal to make a trade.
Yep. And it's a great lesson for new users. And what we're talking about is the green part of the graph here. Once it's above the red line, it doesn't mean the market's going to instantly fall apart. And notice that it stayed there. It didn't go whoop and drop, it stayed there. And the supply side was falling. But you now know, what is the probability that the market continues to rise? Well, it's less and less and less and less and less. There's no question. What is the probability here that the market rises in the next few days? Well, very high. But unless the supply drops too, it will be very brief. And guess what? It was 1, 2, 3, 4, 5 days. The stuff in the market, it's not perfect. Sometimes it's 2, sometimes it's 8 days. But that 5-day pattern is very telling. And we see it it's the model we run to determine behaviors. Because if you have a large position, if you're running $1 billion and I have to move it, how long is it going to take me? Well, about 5 days. You get enough parties to take the other side. Something to know, right? So, yeah.
Tim, what time of day are you checking it? Is it the opening or the closing when you typically check your status?
I check. I check at the open. I do, particularly if I'm looking to sell something. So, like Starbucks. I gambled on that a little bit. I'm not crazy about owning something before an event, and they had an analyst day. I didn't see it. Fortunately, it worked out. I could tell there were long bets, but it doesn't mean they're always right. I could tell that hedge funds were betting SBUX would rise with its analyst day. Here's how you could tell. But I checked immediately. Right? So what I was yesterday. So immediately at the open, I checked yesterday, and it was going up and up and up, and I didn't look back. I mean, it closed a little. I sold it at 92.01. That was my average price. It took several trades, but I'm happy with that. I bought it at around 88. I sold it for 92. Well, it's a pretty nice return. But I noticed that the data told me too, right? The data said there's your uptick in supply, still below the trend, but that absolutely confirmed for me, get out, don't hang around. And so that's at the beginning of the day. Depending on how the market's going, I might say, well, because I know who's setting the prices at the open, high frequency traders. The investors with a horizon of a day or less price all stocks at the open. It's effectively the law. The NASDAQ is a market-making model. That is, it's called time priority, which means the first best price prices the whole market, even with one share. So a high-frequency trader could trade one share of SBUX, and somebody buys it, hits the offer, that will price the entire market. They could cancel the whole rest of the trade. So, and it happens all the time. We look at that data. 15% of trades are for 10 or fewer shares. So that can price the market. So I know that's occurring. When it's in my favor and I'm trying to get out, I'll use it. If those people are pushing prices down, I might use that for an entry. Once again, volatility. How much has a stock decline? What's its movement daily, and is it down a good portion of that? That's how I bought SBUX, by the way. It was, you go here and you say, okay, let's find SBUX in here. SBUX, there it is. And so it's 2.8% intraday volatility, trades $7,800 at a time. So it's down 2%. I go, I'll buy that. Then if it's up 3%, that is you're better than all of the intraday volatility. So you should take that, right? Because it's unlikely that you will do better than that in the short term. It's very likely that if a stock goes up its full volatility, that the next day it will be down some of it. It's not an absolute. It's just a good rule of thumb, because Starbucks trades 80,000 times a day. So good thing to know. That was a long, windy answer to your question. Okay.
No, that's great.
Questions. Let me take some questions here.
Hey Tim, I have a question for you.
Fire away.
Would it be possible in the next release of Edge to add the ability to do folders so you could organize your portfolios, your static portfolios especially, where it would be nice to be able to take like a spreadsheet worth of stocks and be able to import them in to create a portfolio. So that'd be one thing, but it'd be nice to be able to organize into folders on the top level sheet here, so that you can basically have different plays that your different strategies and you can organize them better rather than having a flat thing that you have now where you got to scroll through however many portfolios you create.
I've made a note, and we'll kick it around internally. One thing that would cause me personally to push back on a little bit is that I have started, believe it or not, I've started deleting stuff. I'll tell you my thinking behind this. That less is generally more. So I'll give you an example. Do I trade clean energy on the basis of this? Well, I mean, I could look at it and say, well, demand's rising and supply's falling in the clean energy group. But am I going to trade clean energy as a group? No, I'm probably going to use the math that Edge gives me. I think we can get even better at that. And that's my focus. So I've started to say, well, then why am I doing that? If it's not affecting my decision to buy or sell something, then I'm wasting time by looking at it. Bluntly, right?
So what I
mean,
do
it's
is
interesting, right? But
what I do is, because I follow different, like semiconductor different things. I just use the naming convention and give it a 1, 2, 3, 4, and then the name, and it shows right up at the top.
there you
And
go.
I don't have to scroll down.
Okay, that's a good idea. That's a good idea. So
Quick question.
Yes, fire away.
Oh yeah, so it's going back to volatility because I see the volatility on the volatility of Starbucks was 2.8. And where do we find it? Where it is for the day? Is it regular, like on our stock reading chart, whatever you're using, tells the volatility for that current day? Is that what you're comparing to what you have on your chart there?
So if I understand your question, do you mean, so if we look up, let's say we look up SBUX, and you say, well, it's not telling me volatility there.
Yeah, it was 2.8. I think if you brought it up there, and but then. What am I comparing that to see the difference? As I'm saying, you were saying like, oh, I see it's down from that reading. Is that like on the regular ticker?
Yeah, right. So if I go, let's just if I go out here, let's say, and I'm going to use Google. Google's got real-time data. So like it's down a little bit here. Notice. Selling it at 92, pretty good decision, probably, right? So it told us that I'm probably not going to get a lot more. So it's down. See, it's down 0.5%. If this was down 1.5%, and I think that SBUX is a good buy, that's what you're comparing it to, right? So if I know it moves 2.8%, it's down 1.5 or 2%. Wow, that if supply and demand are diverging, and all other things being equal, context, broad sentiments moving in my favor, got good divergence, I'll buy that. That's what I mean. Yeah.
Perfect. Thank you.
You bet. Okay. Last question. Yeah,
you mentioned ENPH today in your newsletter, and right now it is down like 3%. So do you go basically when it is half of what your volatility is? If it's down, would you be buying?
Okay, that's a good question. Yes. Now again, options expiration, Steve, I'm not crazy about it, but yeah, here, drop down to 310. So let's go look at it. You could do the same thing here, ENPH. Maybe we'll just go look at it in clean energy because that's a portfolio it's in. So we'll go over here, look at ENPH, and I'll look at that. So first off, it moves 5.6% daily, right? Up. The 30-day trend is up, but that's still not bad. So here's the thing. So good demand, falling supply, not huge falling supply because it's still above trend, but is that a good entry? Could be. I'd look at that and say, as low as short volume is here, see it's 48% and the whole market is over 50. Would I buy that? If options weren't expiring, absolutely. That is, I'd buy it right now. Go buy it. Yeah. It's a great illustration. Does that make sense, everybody? Okay. Okay. All right, I think we better call it. I don't want to keep you long. It's time is precious.
Great, thank you. It was good.
Good to see everybody. We will, as soon as we can process this, we'll post it. I should be able to include it in the market desk note tomorrow, and I'll be back on the usual schedule tomorrow. So. And
you think you'll have tomorrow? You'll have the being able to screen for the down moving supply.
Well, that's our internal deadline. So when the team has a target, I got an update from them Tuesday, and they said all that stuff's done. We've got to do A, B, and C yet. So it's supposed to be. Now, will it get pushed tomorrow? We usually push stuff on the weekend so it doesn't interfere with people, but I'm hopeful. I'll just qualify it, say these things don't always go as you plan. So it could software, you know. So but the key takeaway is we're doing it. We're going to have that on the platform. The hard part was this, Steve, to figure out, okay, how do you add it now as a criteria so that you can use that? That was the hardest part because we had to add fields in order to do it. So yeah.
Okay. Well, I look
Okay,
forward
guys.
to it.
Okay.
Thanks.
Good to see you.
Take care.
You
Thanks,
too.
Thank you.
See ya.
Thanks, Tim.